Welcome to the topic 5 homework, and what we'll be doing today is forecasting, financial statements in the future. In front of you, you see the Excel spreadsheet that you have that you can use for your homework, and in front of you, you can see that there's essentially a bunch of years here from financial year 2011, 2015 for the historical period, and for the forecast period, we have 2016 until 2020. So effectively speaking, we'll be using the past information to inform us something about the future, and using that kind of information, we'll be able to forecast the financial statements. Now down here, you'll see very condensed financial statements with very few line items because that's all we need for valuing the firm. So we have the income statement, we have the balance sheet, and we also have the cash flow statement at the bottom. So what we'll be doing first is we're going to be populating the income statement and the balance sheet and the cash flow statement with the past information, because this past information can then be used to calculate the ratios for the past, so we can kind of get an understanding of what they might be in the future. So to do this, we'll get started by getting sales for 2011, for example. So to do that, I would put an equal sign, go to the income adjusted sheet, get the sales for 2011 in C6, press enter. Now, cost of goods sold, you get from the income statement as well, but what's important to remember for the cost of goods sold is that you need to get the cost of goods sold or cost of revenue that's exclusive of depreciation and amortization. So this is located in C9. So you want to get it exclusive of the depreciation, because you see here in C8, we have cost of revenue, but that one includes depreciation, and we want to get that one from C9 instead. Now we have those two figures, we can actually calculate the gross profits ourselves by subtracting cost of goods sold from sales. Then to get the sales, general, and administrative expenses, well, you can get that yourself from the income statement, or you can kind of take a slightly shortcut by instead finding the EBITDA. So I'd go to the income statement, and if you go to the bottom of the section here, you'll see that there's a bunch of reference items, and one of them is EBITDA, which is earnings before interest, tax, depreciation, and amortization. So effectively speaking, the difference between gross profit and EBITDA is the selling, general, and administrative expenses, which means that we can actually figure out what this is by subtracting these two amounts. The next item is the depreciation and amortization. Again, as a shortcut, I usually just go and find the EBIT in the reference items. So in C62, which means that I can find the difference between the EBITDA and EBIT, and that will be the depreciation and amortization. Now next we have the interest expense. Now, interest expense is quite easy to get from the income statement. So I go back to the income statement, I go to the top, and I'll go down and I'll try to find where the interest expense is. So I can see here, there's in line 22, there is a section and that's called interest expense net, and I just reference C22. So EBT stands for earnings before tax, which is effectively just EBIT minus interest expense. Now what you'll notice is that interest expense is negative, which means that it's technically an income. So whenever interest expense is a negative, it gets added back onto your earnings, because in this case H&M doesn't actually have any financial debts, it has financial assets. Now next we have tax expense, and we go back to the income statement, and we'll try to find the tax. So if you go look at pre-tax income, and then in line 29 we see income tax expense in C29, which means that the net profit is effectively just the earnings before tax minus tax, and that is effectively it. Once you have these kind of items, you can essentially drag them forward to 2015 and everything will be calculated for you. The next items that we'll be looking at is for the balance sheet and the cash flow statement. So first, for the balance sheet, we just need to get the total assets, total liabilities, and so on. So for total assets, we'll say equal, we go to the balance sheet, And again, remember that on the balance sheet, 2011 is in column D. So total assets, column D, is in D35. Total liabilities, again, balance sheet, column D, row 61. Now that we have these two items, we can calculate total equity ourselves by subtracting total liabilities from total assets, so total assets minus total liabilities. Now, financial debt, in this case, it refers to any kind of debt that is interest-bearing. So to get this amount, you can go back to the balance sheet, and again, you can kind of figure out yourself by adding a few different rows together, or you can go to the reference items at the very bottom of the balance sheet, and you see where it says net debt on row 83. So D83 will give you the net debt or the financial debt that H&M has. The next item that we need is working capital. Now, working capital is a bit tricky because what working capital stands for is your current assets excluding cash minus your current liabilities excluding short-term debt. And again, if you hover over working capital, you'll see a comment there that kind of gives you the definition. So in order to calculate this, we need to say equals, and then we're going to open up a bracket. We're going to go to the balance sheet. We're going to find our total current assets in 2011, subtract the cash and cash equivalents, so in cell D7, close the bracket, and then subtract that, open up the bracket, take our total current liabilities in cell D49, and subtract the short-term debt. Now in this case, H&M has a short-term debt of 0, so it doesn't matter, but for your company might have some short-term debt. Press enter, and we get the working capital for H&M. Again, you can highlight all the ones that we've currently calculated, drag it to the right, and we get those fields populated as well. Now, the final section is the cash flow statement. Now, the cash flow statement, we're just going to try to essentially estimate what the unlevered free cash flows are for each of these periods. You'll see that what we do is we essentially use the indirect method where we use the net profit and then we add back any kind of non-cash expenses and subtract any cash items that you wouldn't have seen in the net profit. Now, what you'll see is that we have interest expense, depreciation and amortization, capital expenditure, and increase in net working capital. So what we're going to be doing is, well, we need to essentially find all of this information. Because we have a field here which says increase, it essentially just means that it relates back to the previous period, which means that the first year that we can actually calculate this for is 2012, because in order to calculate the increase in net working capital, we need to compare it to 2011. So for 2012, for net profit, we would essentially just reference the net profit, so 16,867 in this case. We would add back interest expense. However, our interest expense is on this line item, so on the row 23, so D23. However, this is before tax because you can see that interest expense is before we take out tax. What we want to add back on the cash flow statement is the after-tax interest expense. Now, this is slightly tricky, but what you would do is you would reference D23 and multiply that by, open up a bracket, 1 minus the tax rate. Now in this case, we don't have the tax rate calculated yet, but we will be putting the tax rate into cell D8 because you see here under assumptions there'll be a tax rate. Right now it's blank, but soon they'll be populated. So we take 1 minus D8 and that will give us the after-tax interest expense. Depreciation and amortization is quite easy. We have that in row D21 or cell D21. Our capital expenditure is something that you can get from the cash flow statement. So in order to do that, we're going to enter equals, the equal sign, and then we're gonna put in a minus or subtraction. And the reason for that is because the capital expenditure on the cash flow statement is already negative. So otherwise we would get a double negative effectively. So we're going to find acquisitions of fixed and intangible assets, which is essentially your capital expenditure. Press enter, and again you see that it's positive 6,827, which is because we added that negative sign at the beginning. Then we have the increase in net working capital, and all that is that you take cell D34, which is working capital for this year, and compare it to the working capital last year. And we can see that the working capital has increased by 2,195. Now finally, the unlevered free cash flow is equal to the net profit, and you can kind of see here on the line items, it kind of gives you hints, so plus, plus, minus, minus. So we're going to take equal to net profit plus interest expense plus depreciation amortization minus capital expenditure minus increase in net working capital. Press enter and you get 11,019. Again, you can drag this to the right and so on. So this essentially finalizes this section. Now you'll do remember that this interest expense will probably change once we've actually entered something into the tax rate and under assumptions, but you have the formula already done. So what you can do now is you can go to the top section, and we're going to effectively be populating the assumptions, and specifically the historical assumptions. So the historical assumptions section is essentially just telling us what the previous year's ratios were, so that we can then try to forecast them for the future and use these forecasted ratios to calculate these income statement, balance sheet, and cash flow statements. So here we have all of the assumptions that we need to calculate. So again, we can just start. And again, sales growth, it relates to how much sales have grown. Because we have 2011 as our first period of information, we can only start calculating sales growth in 2012. So take equal to, open up a bracket, take the difference between this year's sales and last year's sales, close the bracket, and divide it by last year's sales. And we can see that sales have grown by 9.82%. Drag it to the right and you get all the other years. Gross profit margin essentially tells you how much you make in gross profit in relation to your sales. So what you do here is you take the gross profit divided by sales. And you can see here that you keep 60.47% of all the sales dollars as you keep them as gross profit. The EBITDA margin, very similar. You take EBITDA divided by sales. Your depreciation to total assets effectively tells you how much your depreciation and amortization expenses are in relation to your total assets. So C21 divided by C29. We then have the interest rate, and the interest rate is effectively whatever you have in interest expenses right now, or in our case income, and we divide it by the financial debt of the firm. So C23 divided by C33. We then have the tax rate, and the tax rate is our current year's tax expense divided by the earnings before tax. So C25 divided by C24. Then we have the asset turnover, and that essentially tells us about our asset efficiency. In order to calculate that, we take our sales and we divide it by our total assets. We then have our total liabilities divided by total assets. That's kind of a self-explanatory ratio. So we take our total liabilities and divide it by total assets. So C30 divided by C29. Our financial debt to total assets, very similar, but in this case we take our financial debt divided by total assets. We then have our working capital to sales, which is, again, working capital, find it in C34. and you divide it by current year sales, which is in C16. Capital expenditure to sales essentially tells you how much you spend on capital expenses in comparison to your sales. So in order to get that, we would then need our capital expenditures for this year. Again, in the cash flow statement, we started with the year 2012. So we're going to start with 2012 here as well. So we're going to take 2012 capital expenditure and divide it by this year's sales. So D40 divided by D16. Now we have all of the assumptions calculated for us. Again, we need to drag some things to the right so that we can populate all the 5 years. And this will give us the historical assumptions that we can use to forecast the future information that we need. Now, the important thing to note is, again, this is a very mechanical forecast. I'm not going to tell you exactly how you would figure out what the appropriate forecast is. But for example, for sales growth, if I highlight the cells that have sales growth in them, in the bottom right corner here in Excel, you can see there it says average 13.37. So I know over the past year, the average sales growth has been 13.37. You can also see that it's kind of jumped up and down a lot, and that's really because of currency fluctuations. So if I wanted to figure out what might be an appropriate sales growth, I know that it's been, on average 13.37 in the past. Maybe I'll say 13%. Now, again, in the lecture, we talked about the idea that sales growth is mean reverting. So over time, companies that have a high sales growth, and in this case 13% is quite high, will revert back to the mean. So usually when we forecast these sort of things, we kind of have a decrease in sales growth over time. So I'm going to go down to 12, 11, 10, and then 9%. Now for the other ratios, technically speaking, in practice, we would almost always either use the last year's ratio or the average of the last 3 years. And again, in this case, I'm just going to take the last year's ratio because that's easy. Going to do the same for all the other ratios, which just essentially means that we believe that the relationships will essentially be constant over time. So really the only thing that we've changed so far is the sales growth. Again, once you've selected that, you can drag it to the right, and they'll be exactly the same over the next few years. Now, once we have the assumptions, we can essentially then start to forecast the income statement, the balance sheet, and the cash flow statement. So for example, to forecast sales for 2016, we would take the last year's sales, multiply it, open up a bracket, 1 plus the sales growth in 2016, close the bracket, and you're done. Cost of goods sold, well, we can't forecast that, but what we can forecast is gross profit by using the gross profit margin. So what to do that is we say equal to this year's sales multiplied by the gross profit margin in this year. So it's H16 multiplied by H4. And again, the cost of goods sold is merely the difference between these two numbers. EBITDA is again just your current year sales multiplied by the EBITDA margin. And the selling, general, and administrative expenses is the difference between the gross profit and the EBITDA. We then have depreciation and amortization. In order to get the depreciation and amortization, what we're going to be doing is we're going to use our current year's assets and multiply it by the depreciation divided by total assets, so essentially the depreciation rate. For this, we actually need our total assets figure. So what I can do is I can already kind of calculate the total assets right now. So in order to do this, I would say equal to, and I'm going to use the asset to turnover ratio to calculate it. So in order to do that, I need to take the sales and I'm going to divide it by the asset turnover, which is in H9. So H16 divided by H9. And that gives me the total assets for this year. So again, once I have that, I can then start to figure out the depreciation and amortization, because depreciation and amortization is going to be the total assets for this year multiplied by the depreciation rate. So H29 multiplied by H6. Your EBIT is your EBITDA minus your depreciation and amortization. Your interest expense, again, we kind of need to forecast some of the balance sheet items because your interest expense is going to be equal to your financial debt multiplied by the interest rate. So in order to do this, we actually need the financial debt. So the financial debt we forecast by taking the ratio of financial debt divided by total assets. So in this case, we're going to take equal to total assets and multiplied by the ratio of financial debt to total assets. Now we have that figure, and we can essentially then go on and forecast interest expense. So interest expense is equal to your financial debt multiplied by your interest rate. So H33 multiplied by H7. Your EBT is equal to your EBIT minus your interest expense. Again, the interest expense is within brackets, which means it's interest income, and that is the reason why EBT is higher than EBIT. Now your tax expense is merely equal to your EBT multiplied by the current year's tax rate. We forecasted this as the last year's tax rate, which is 23.29%. And your net profit is going to be equal to your EBT minus your tax expense. And that's effectively it. Now we're going to be populating some of the missing fields right now. So for example, total liabilities is going to be equal to your total assets multiplied by your total liabilities to total assets ratio. So H29 multiplied by H10. Your total equity is merely the difference between these two amounts. We then have working capital. Now working capital is going to be calculated by using the working capital to sales ratio. So in order to calculate it, we take equal current year sales multiplied by working capital to sales. So H16 multiplied by H12. Then what we need to do is we need to also forecast the cash flow statement. So cash flow statement is going to be, again, using net profit as the starting figure. We're going to add back interest expense. So we're going to take our interest expense, but again, remember that we're going to use it and take it after tax. So we're going to take 1 minus, H23 multiplied by, open up a bracket, 1 minus the current year's tax rate, which is an H8 in this case. Close the bracket, and we get negative 260. Our depreciation and amortization, it's pretty easy. It's in cell H21. Our capital expenditure we don't have, but we do have is the ratio capital expenditure to sales, which means that we can take our current year sales figure and multiply by capital expenditure to sales to estimate what the capital expenditure is for this year. We then have our increase in net working capital, and that is effectively just your working capital this year minus the working capital last year. And then finally, we come to the unlevered free cash flow, which is equal to the net profit plus interest expense plus depreciation amortization minus capital expenditure minus increase in net working capital. So we have a positive 15,705. So now we've calculated all the forecasting for 2016. Again, all of this can then now be dragged to the right. So I can start with the income statement. Again, you can see that some fields are blank because some fields are needed from the balance sheet. They'll be populated once we have that information in the balance sheet. And as you see, the income statement has been updated. And then finally, the cash flow statement as well. And that's effectively it. And you've now forecasted the condensed financial statements for H&M, and you can do the same thing for your company. And these financial statements we'll then start using in topic, I think, 7 and 8, when we start to look at how we actually use this forecasted information and use it in a real valuation. That's essentially it for today. So once you're finished, just upload it to iLearn.